In just 7 years, there has been a £47 billion increase in the number of charity assets under management. Essentially, these assets, excluding property assets, represent the surplus funds available to charities which they do not need for their immediate use and have placed into investments to seek a better return to bolster the charity's income in future years. By the end of 2017, over £108 billion of assets were under management. With public expectations and attitudes shifting towards greater focus on transparency and sustainability, it is becoming more important for charities to ensure that they have robust procedures and internal controls to ensure that the way they safeguard the charity's assets and invest the surplus funds is in line with the charity's objectives. Here is our quickfire 5-step guide to charities considering investing their surplus funds. Number 1, know the legal requirements. It is imperative for charity trustees to know what financial investments they can make. Specific powers of investment may depend on the constitutional form of the charity. For example, whether the charity is unincorporated or is a company. In addition, the charity's governing documents may place additional conditions or limitations on the use of this power to invest. 2. Ensure there is a defined operational process. It is essential that before embarking head-on into a project to place the charity's assets into investment, trustees would benefit by having a clearly defined internal process of how they will oversee the assets which are being placed into investments, including how they will select and oversee the investment managers which they have delegated this authority to. 3. Undertaking active learning. It is important for trustees to undertake their own research to understand their role and responsibility and not simply to rely on the multitude of marketing material which charity investment managers may throw towards them. Getting independent training and advice is critical to ensure that trustees avoid groupthink when making key decisions, especially around investing their assets, including the selection of asset managers. 4. Understand the risks. Risk is essentially an important part of the investment process, and there are several risks that trustees should consider, such as, for example, capital risk, liquidity risk, market risk, and also tax risk. The last one is often overlooked, where trustee charities may naturally think that there are no tax consequences. However, if making foreign investments where there is not an equivalent tax relief for UK charities in the country is concerned, then the investment returns may be reduced by foreign tax. 5. Develop an investment objective. Having a clear investment objective which outlines what assets the charity can place into investments, how and under what criteria those assets will be managed, and what is the role of the investment manager will be an important prerequisite before embarking upon placing the assets into investment. In summary, remember this simple acronym LOL arrows when undertaking charity investments. This represents legal, operational, learning, risks, and objectives. As always, if you'd like any more information, please do get in touch with us through the usual channels.